Hi, my name is Frances MacDonald and I'm a founder and director at Capstone Income Fund. Capstone Income Fund is an Australian real estate debt fund, and real estate debt is a great asset to add to your portfolio because it offers double-digit returns, it has less volatility than equities, greater yield than fixed income, and overall is a great diversification strategy for your investment portfolio. Let me get into who we are and what we do. I'll skip over the T's and C's and go into what is this opportunity that's available. And there is a unique opportunity for non-bank lenders in the market to generate outsized returns. And that's because traditional banks have retreated from certain segments of the market that has allowed non-bank lenders to come in and realize returns at a premium to those received by banks in underserved parts of the market. And also borrowers in some segments really favour non-bank lenders for their speed and their flexibility. On the investor side, private credit has been the alternative asset class of 2023. In the period we've had of volatility, inflation, and macroeconomic uncertainty, private credit has been very attractive as a yield strategy and diversification source. At Capstone Income Fund, our fundamental strategy is to deliver outsized returns relative to risk to our investors. We do that through investing in a diversified portfolio of registered mortgages. We target higher interest rate short-term loans. Our loans are generally 6 to 12 months in tenor, and that actually minimises our risk profile because it means we are less exposed to longer-term market volatility, and we're generally very aligned with our borrowers on the exit of the loans. The majority of our portfolio is first-ranking security, which means we are first in line to be able to take over an asset to recoup our principal and our interest if we need to. And we have very strong capital preservation in our fund. Not only do we invest in very deep liquid areas around key cities, but we also have a conservative LVR, which is our loan to value ratio of 60%, meaning there is $100 of value underpinning your investment for every $60 we've lent, giving significant headroom for market fluctuations. Our offer to our investor base is a consistent, high yield, passive income stream of 10% per annum. We have a very flexible product giving monthly distributions and no lock-in periods. And a really attractive thing about real estate debt is the level of security underpinning your investment. At Capstone Income Fund, we have multiple lines of defence. We have a conservative LVR backed by real assets. We're primarily first mortgages. We have strong processes in place. We have strong contractual protections, and also management is invested as a first loss investor. That means our capital is at risk before there's any risk to investor capital, offering true skin in the game and another line of defense on your investment. Now let's take a step back and go, why would you invest in real estate debt? Rather than going, for example, direct property investment, which has long been a source of resilience and growth for investors. Investing in a real estate debt fund allows you to get exposure to the property market while minimizing the risk and effort. It has greater liquidity and lower upfront costs when compared to if you were to purchase a property directly. Now, the key thing that I find really attractive about real estate debt is, one, it is an asset-backed security. There are real assets underpinning your investment. Second, debt is higher up in the capital stack, and if anything goes wrong, we are repaid first. So you see on the right-hand side, equity takes more of the price volatility, while debt doesn't look to underperform or overperform, but we are repaid first, lowering the risk profile. The third thing that's really important in debt is the loan to value ratio, that we always lend to something where there is more value than our loan, so that can give us more headroom for the ups and downs of the market. From a returns perspective, real estate debt is high yield and has less volatility than other asset classes. What you can see on this slide is the most recent term deposit rate of 4.55%. That is quite equivalent to a risk-free rate, and you can see on the right-hand side how that compounds over time. Equities in comparison, here we're looking at the Australian All Ordinaries over the last 5 years, and that's been extremely volatile. We've had recovery in most recent times, but due to the volatile nature of equities, it's always good to balance your portfolio with other assets to act as a shock absorber. Real estate debt and Capstone Income Fund in particular, what we see here is a consistent compounding 10% return. That offers a really stable, reliable, regular income source where you can see how that grows over time, and that's really attractive about real estate debt. Just to give you a little bit more flavour of actually what do we do and what do we invest in. As I've mentioned, we have a diversified portfolio of short tenor loans, generally 6 to 12 months. And some of our key categories are residual stock, bridging loans and land deals. What you can see here is some of the assets that we've invested in. So on the left-hand side, this is a wonderful apartment building in Redcliffe, Queensland. Queensland, as many would know, has had a boom in the property market. In this asset, the developer has finished the construction of an apartment building and their construction facility has come to an end, and they need a short loan to get them through the sale of the remaining apartments. You'll see in this one, we have a value of 2.6 million, term of 12 months, and an LVR of 66%. This is a great asset for our fund because it's a very low risk profile. In this instance, a number of the apartments were actually already pre-sold. So you've got a really good indicator of value and the exit's very clear. In the middle, you see a beautiful building in Mosman. This is a bridging loan, 3.6 million of value, a very short term, and a very low LVR. So again, a very clear exit for this loan. On the third category, you see a land deal that we've done in New South Wales for 2.5 million. In this instance, the developer was in between planning approvals, and once they got their DA, they would then refinance to a construction facility. With land deals, we always look to have a lower LVR, given it is a land deal. So that's an example of what we do. Some of the key takeaways about our fund that I want to leave you with is we have a 10% return with very strong risk metrics of 60% portfolio LVR. Over 85% of our portfolio is first registered mortgages. We have a strong track record in place. We've been operating over 5 years as a non-bank lender. We've done nearly 100 loans actually with no capital loss, and we've always met our 10% return in this fund. We are putting our money where our mouth is, and management is invested as a first loss investor, offering another line of defence to your investment and showing that we really stand behind our business model. And we also seek to offer a really flexible product to our investors, meaning there is no lock-in period, and also you get monthly distributions so you can see that return coming into your account every month. We are open to wholesale investors with investments starting from $100,000. I'd love to have a chat with anyone who's interested, so please reach out or come and download our IM. Thank you.